Hey, everybody, we have seen earnings from some of our favorite companies, and one that we are very excited about. Tyler can hardly contain his excitement, is Redfin. As mentioned, Tyler is joining me. Redfin just reported their third quarter numbers, and just like the real estate market itself right now, it's okay. Before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It's the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. So, Tyler, just to run through some of these numbers, it's about what you would expect given the market environment right now. Revenue was up 3% year over year because essentially the real estate market's just as bad as it was at this point in 2023 is really what the stats are telling us. Real estate services, their gross profit was down 10% year over year. They're profitable on an adjusted EBITDA basis, but as I've mentioned in other videos, we all know what Charlie Munger used to say about adjusted EBITDA. Look it up if you want. But I look at the net loss, especially when their stock-based comp is unreasonably high. They ran a net loss of almost $34 million for the quarter versus a net loss of $19 million a year ago. And probably the biggest alarming stat to me, and I'll let you give your thoughts in just a second. I'm sure you're going to say something very similar. The most alarming stat to me is that their market share is dwindling. In the third quarter, their market share, not dwindling, it's a strong word, but their market share went from 0.78% of the real estate of home sales in the U.S. a year ago to 0.76% now. And at the same time, their agent count went up by 1%. There are some positive stats, like their mortgage attach rate went from 22% to 27%. They own their own mortgage company. The rental business is performing well. There's really no denying that from the numbers, that's doing better than expected when they bought it out of bankruptcy. They rolled out their Redfin Next Pay Realtor Pay plan, which they're very optimistic about. But in short, they really need a good real estate market for these numbers to turn around. There's really no getting around that. This is not a business that works when the market is terrible. Their stock-based comp is exceptionally high, in my opinion, a rate of about $70 million a year from a sub $1 billion company. I'd love to see them get that a little more under control. To be fair, it's down year over year a little bit. And CEO Glenn Kelman said that just sounded very, very optimistic, and I would have expected more commentary about how bad the real estate market is. We recently did another video about Opendoor, and management was very honest about the state of the market. It was actually kind of refreshing in a way, where they said this is, the market's even more challenging in a lot of ways than 2023. This is the slowest existing home market since 1995. Glenn Kelman just says we're going to hire a bunch of agents between now and next spring, and we're emerging from a year of record low U.S. home sales, ready to go on the attack. So I'll end on that. Tyler, what are your thoughts on the numbers and just kind of the business in general?
Well, you touched on it a little bit earlier, but one of the things that, a while back when Redfin ditched its iBuying business and it kind of really went all in back on its kind of core business of agents, and we'll call it like lead generation a little bit, because like for as much as it has its own agency kind of built in versus like a lead gen Zillow, it's still very much a top of funnel kind of business, right? Like traffic to its website drives lead gen for the agents that are in its business. So a couple, when we went back and we saw that the market for housing was way down, and like there's nothing you can do about that in terms of like your business. That's one of the things out of your control. And I had said at that time, it's like, look, you can't do anything about that, but what the thing you can control is taking market share. As long as you can continue to take market share in this industry, regardless of it's an up or down industry, that's progress. And it's not happening. And that's, to me, the most frustrating aspect of this. Not, as you said, its market share by units is down year over year and from the prior quarter. But also its average monthly visitors is also down. So your top of funnel is shrinking still. And to me, that is, I think, should be priority focus number one, is the top of funnel, getting people in and gaining your market share. Yes, the rentals business nice, the attach rates on its mortgages are nice. Like you can fluff the earnings presentation as much as you want with all of these side things, but all of that stuff doesn't matter is if you don't drive traffic to your site and take market share. And that's not happening right now. And to me, that is the for all the things that management has said about focus on efficiency, take market share. These were all the talking points a couple of years ago, but they've gone away. And I feel like there's been a lot of like management drift, thesis drift, just kind of aim not really having this clear execution goal on this business. And that's been its problem, I think, for its an entire existence. You know, as much as Glenn Kelman seems as a visionary leader, execution at this business, in my opinion, has been poor. And as long as that continues to be the case, I just don't see this business as investable. I think that there are too many issues, and there doesn't seem to be any urgency to fix it, because if you're issuing that much stock-based compensation every quarter, guess what? The employees don't care if it does get better because they can just cash out stock.
Well, I do like you mentioned compensation. I mentioned briefly that they have kind of redone their agent compensation program. Redfin's been known for not using the traditional commission model of a real estate agency. That's how they can charge 1.5% instead of 3% on a home sale. They've had salaried agents that are just very efficient. They're now switching to a commission model. That's what the Redfin Next Pay plan that I mentioned was. It's designed to recruit better performing agents, give people incentive to, as you mentioned, bring people to the top of the funnel. And that just rolled out nationwide on October 27th. It's worth pointing out. So, after the end of the third quarter, this is now in effect nationwide. It was in a few markets, I think in California, with positive results, but that has not been reflected in any of the numbers yet. So that's worth watching at the very least over the next couple of quarters. I'm not saying it's going to pan out to anything, but it's definitely worth watching because that's something I think they should have done a while ago, if I'm being honest. But you're absolutely right that the market share declines are the biggest red flag in this quarter. And we'll have to see because, in a great real estate market like 2021, any real estate company looks fantastic. Opendoor looked fantastic. Even its kind of younger sibling OfferPad looked fantastic for a time. Redfin looked great. Zillow looked great. I remember when Zillow was, buying house. Zillow bought like 3 houses in my neighborhood in 1 week. It was, everyone looked like a genius at that point. Now the market's terrible, and these businesses really needed to reset and figure out how to be sustainable, even if the market's bad. Because when you think about traditional realtors, Tyler, we mentioned some of these before, just talking before the show, like, Century 21 and things like that. They survive during down markets. They've been around for a long time. And it's because their business is, it's traditional, it's not disruptive, but it works in any type of market. And Redfin really hasn't shown that it can be profitable in a bad market. On an adjusted EBITDA basis, sure, but as far as actual bottom line income, there's no reason that you're selling almost 1% of the homes in North America. That's a pretty good size business. There's no reason you shouldn't be able to make money off that. So they're heading in the right direction. I'm hoping for their sake the real estate market turns, but I want to see them double down on the efficiency of this business. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.